Hello, everybody. Mike Sorrentino here, along with Bepin, and we are back with our market pulse for the week. And it's been an interesting week or two since we last talked. I think what's going to be interesting about what we discussed today is that there's there's no common theme. There's no
Yep.
underlying trend. There's no story per se. It's almost kind of like a vignette of these different narratives that are flowing around the market right now. Obviously, a lot of concern about AI with that Citrini report. I don't know if you got a chance to read it, but it's been all over the internet the past 4 or 5 days now. We've got some economic data that's come out that's raised some eyebrows, and a lot of stuff in between. So again, a couple vignettes today. They don't necessarily connect together or anything like that, but I do think that they're certainly worth discussing. So let's jump in. Great quote from Mark Twain. I strongly recommend not trying to do this yourself because it is a tongue twister. I've had some practice though. It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so. I think that
Powerful
is
quote.
very, very powerful. I'd say Mark Twain, and I'm a big fan of quotes, Bepin, as you know. I would say Mark Twain probably is in the top five all time in terms of consistency of great, great quotes. All right. So there's some signs of life. This chart here is interesting. Let me explain what's going on and then the kind of the underlying currents. That blue line at the bottom, that blue line is the S&P 500. Okay. So that's the performance of the S&P 500 year to date. Okay. Go back to, call it January 1 or whatever the first day of the year was. I actually don't remember what that is anymore. But from the beginning of the year, and it's not too bad. It's a respectable start to the year, given the fact we've had some volatility, given the fact that it is a midterm election year, which is not always the most enjoyable of years. But that purple line at the top, I think, is even more interesting. So the S&P 500 is what we call a market weighted index, meaning that if you're a bigger company, you have a higher weight in the index. So Apple's going to have a higher weight than, well, pretty much most other companies, right? So that's effectively how it works. Now, there's another ETF out there that actually does what we call an equal weighting of the S&P 500. So Apple would have the exact same weight in the index as Google or Johnson or any other company that you could think of out there that's in the index. Okay. The reason why we do an equal weighted index is because we want to see if every single company had an equal weight, how would this index of stocks perform? And that index, or I'm sorry, that ETF rather, excuse me, the equal weighted ETF has done phenomenally well. So what does that tell us? That tells us that some of the smaller stocks, aka not the Magnificent Seven or 10 or whatever the number you want to pick to, anywhere between 5 and 10, let's put it that way.
Yep.
Those stocks are not driving the index this year, or the equal weighted index rather. We're not seeing the performance coming out of these stocks in the same way we are other parts of the economy or the index.
hmm
All right. What does that tell us? What does that tell Bepin and myself? To me, that tells me that the rally or the potential for a continued bull market is broadening out. We don't have to rely on seven stocks anymore. All right. We're seeing more stocks coming to the party. And yes, there might be some, we might be experiencing some headwinds with those seven stocks right now with some weakness in certain areas. And I get that. We're going to talk about that. But it's a really good sign, in my opinion, to see a broadening of the rally, to see these other sectors and these other stocks start participating means that investors are starting to look for opportunities in areas other than just technology and AI.
Exactly. A rally of 7, 10 stocks cannot drive a market long term. This just shows that it's a healthy sign that the market's sustainable. We're starting to get excited about all areas of the market, not just those seven that we've talked about for what, like 5 years now, Mike.
Yeah, seems like it.
Yeah, it's nice to finally give the other 493 their time in the sun.
Yeah. And it's not just diversification across the S&P 500 or the 500 largest stocks or the most attractive stocks that are in the index. There's a diversification component to factors, all right, growth versus value, but
Yep.
also regions as well. Okay. And we've discussed, I know we discussed in our State of the Markets a few weeks ago, this idea of international stocks, they did great last year relative to the US, which was the first time in a long time where that happened. But
Yeah.
there's a good chance, and we talked about this chance where this rally that had more fuel in it, or we thought at least thought it did. And so far this year, that does appear to be the case. I mean, look at emerging markets at the very top. When I say emerging markets, now again, uh, take that with a grain of salt, but a lot of these tend to be nations that tend to be um, ha- they have a little bit more growth because of their size on a relative
Yeah.
basis,
Hmm.
but they tend to also be a little bit more volatile. They've really
Of
taken
course.
off this year. International as well. International developed. Okay, that means again, developed areas, particularly in
Europe and
continents like
Japan.
Europe and Japan.
Europe and
Exactly.
Japan
Those are
basically
the
make
two
up the
big
whole
ones.
index. Yeah.
Yeah, yeah. Again, there's a little bit of blurred lines here when we go to developed versus emerging, but for all intents and
Hmm.
purposes, Bepin, you're exactly right. But I mean, look at even for that matter. Look again. This goes into I think like an extension of what we just talked about with the S&P kind of broadening. You're starting to
Hmm.
see small caps and value stocks. It's not just large growth. In fact, large growth right now is at the bottom.
Yeah.
It's not doing well now. No signs for cause or concern, rather.
Of
Don't
course. Yeah.
run to the door. Nothing like that. Okay. The idea here's we always say the irony of diversification is if everything's going up, then you're not diversified. Okay. So
Hmm.
large growth companies in the U.S., in my opinion, still appear to be some of the most attractive long-term investments. But it doesn't mean they're always going to win every minute, every hour, every month, or every quarter of the year. There
Yeah.
are times when we need these stocks to take a breather. We need what's going on right now, particularly in software, in my strong opinion, needs to happen. Okay, because what you're doing is you're shaking out the traders and and all the momos and all these the
Get
euphoria,
rich
the
quick schemes.
emotions,
Yeah.
get rich quick, all of it. It's getting
Yeah.
shaken out.
Yep.
And what are
Yep.
you left with when it's over? What are you left with? You're left with fundamentals. And those
Exactly.
fundamentals right now still look pretty strong. And that's what's going to create the foundation for the next leg higher. But right now,
Exactly.
a little bit of pain.
Yeah, and I mean, again, as you mentioned there, Mike, we're talking about like 2 months into the year here. We zoom this chart out to any other period looking backwards, and large cap growth is going to be one of the top performers. So yes,
It's not even close.
it's very natural to see this period of consolidation where you see a little bit of a sell off, and there's different sectors that are really driving this. It's AI driven for to some extent, but nothing to be concerned about with large cap growth in terms of like as Mike said, the long term nature. These are definitely the stocks that you would believe that are going to drive the future. So it's just natural here.
Yeah, I took the short straw again this week on
Man, you just have the worst luck ever when we're
the
drawing
the
them.
actual worst luck. The actual. This is the reason why I don't do credit card roulette when I go out, when I was younger, living in New York City. I'd go out to my friends and everybody put their credit card down to see who would lose. I lost every time, so I'd end up paying for all my friends' dinners. After like the third time, I just never did it again. Getting back to the important stuff here with tariffs. Look, I mean, I think it's safe to say that it was widely expected the Supreme Court was going to strike down the stance that
75.
it was. Yeah, there was a very, even if you looked at the poly markets and the
Yep.
Kalshi and all these prediction markets,
Hmm.
this was not going to happen. Not to say that the voice of the future or anything, but it was a weak legal argument, and I think it was consensus built that into the output. That's honestly, I think that's one of the reasons why I didn't really move the markets all that much. Um,
Didn't do anything. Yeah.
yeah, it really didn't do anything. I mean, I think the question now becomes what happens, right? Well, there's a lot of questions like, well, we got to refund all this money to all these companies. Okay, we'll see
That's
if one,
debatable too. Yeah.
we'll see. I totally agree. We'll see if that happens. One, two, if it does, it's going to sit in the courts for a few years, most likely, and then three, we'll see if people get paid back. If they do, it's years away, years. So I can't think about that right now and I also don't know. Like nobody really knows how that's going to play out, and I don't think it really matters in terms of our investments, at least as they stand today. I think the key point here is that if you look, rewind the clock, a little bit over a year ago, and that's a blue bar on the left, right? This was before Trump got in office and all the tariff announcements and all that other stuff. So our effective tariff rate in the U.S. was a lot lower than it is today in that red box to the right. Okay. The point here is that our effective tariff rate is still high, like relative to a year ago, a year and a half ago, whatever it was. And there are ways that the Trump administration, and they've publicly come out and said this is what they're going to do. They have the ability to continue tariffs at a specific rate. I want to say it's called, was it 15% across the board tariff, something like that.
Yep.
And they've got 150 days to do this. Okay. So
Hmm.
ultimately, this is going to give the Trump administration, I think, enough time to figure out how to solve for this quote unquote setback, which I think they were anticipating to surgery. I personally don't think that the Trump administration has been waiting for this announcement, Beth, and I got to think that they've been working on. Excuse me. I got to be thinking that they've been working on a plan B for a while. They got
I mean,
150 days. Yeah,
100%, right? I think what the tariffs got stricken down at like 10:30 in the morning on Friday. By like noon that day or 1 o'clock, he went live, and here's Plan B, which was the Section 122 tariffs that you're seeing there at 15%, which, as you can see, the overall rate is pretty close to that original 16% peak. So you're getting majority of the tariff level that he's looking to get to, and he's getting to hold it. And like Mike said, it's 150 days, but we don't expect that once that 150 days passes, that these are going to go back down. As you were saying, definitely this is more of a bridge to buy some time, figure out ways to really get these to stick and have a little bit better legal footing going forward. But switching gears from tariffs here, I'm sure you guys are tired of hearing us talk about those. But again, as they happen, we got to address them. One of the driving narratives in the market that we've seen over the last week, and really since like Q4 of last year, has been kind of this AI disruption theme. And one of the most natural places, one of the earliest places the fear is really going to set into is software. Every month now, there's a new AI demonstration that comes out, and it shows, look at what software I can replace, and it's starting to get priced into the market. So looking at the left there, you're looking at a software ETF versus the S&P 500, and starting back from April, essentially it's followed what the S&P 500 has done. Obviously, there's been some moments where it's risen above and then below, but for the most part, it's tracked the S&P 500 until Q4 of last year. And where you see here is you see a pretty sharp leg down at first, and then a little bit of a recovery, and then it falls off a cliff. And it led to a $1.6 trillion sell-off, which is huge. These are names like Salesforce, ServiceNow, Adobe, are they're softwares that you have in your computer today. And the fear is that AI may kill them, may not in some instances. But the big point is it'll affect their margins. And as the market being a forward-looking mechanism, it starts predicting the future today. So what you're seeing is fear kind of taking over and people reacting to the potential future dystopia that AI could put us in. We're seeing a little bit of a recovery. Obviously, there's the last couple of days here, we've seen software bounce back a bit, but still we're sitting 30-40% off highs for a lot of these stocks. And the real concern is that what else can AI disrupt, where like what's next? Every time that one of these new AI chat boxes, or I believe they're like the on computer ones, every time one of those demonstrations come out, it seems to affect a few tickers here and there. But the overall theme that we've been seeing so far for the last 3-4 months is get me out of software. And the reason being is these companies have fat margins. And if you have really high margins, that means that there's some room for disruption, right? If you have a lot of profit, someone might be able to come in and say, well, I'll take a little bit less profit than them. And then the next guy will take a little less than them, and so forth. And it's somewhat of a race to the bottom. And that's what you're seeing here on the right, which is the forward price to earnings ratio of these software companies. The highlighted area, the bracketed part, is looking at a re-rating essentially. The earnings aren't even expected to drop this year. Earnings aren't really expected to drop too much next year, but they are now expected to drop in the future. At least the margins will. And what you're seeing here is the market repricing what they're willing to pay for your future cash flows. They're looking past the next 2 years, similar to the news industry back after the dot-com bubble. Investors saw the future coming. They saw that it'd be easier to implement ads via the internet than it was to put them on paper. And they started pricing that in long before newspaper companies started seeing it in their earnings. So this is what the market does. It starts predicting future events today. And what we're really getting at is whether this holds or whether it doesn't, we wouldn't be shocked to see other sectors getting hit throughout the year, through the next few years here. As AI really ramps up and we start really understanding its capabilities, it's going to get very easy to start extrapolating out the future of everything's going to zero. And it catches like wildfire. I think there was, as you mentioned earlier, that Citrini report that really influenced this bottom leg that you're seeing here in the software sell-off on that left chart. It really amplified it, where people started all sending it to their friends, started reading it. It read like a novel, and obviously it's easy to be wooed by a novel. It's easy to follow the story along, and a lot of people just took it for a prediction rather than what he said. This is a thought experiment. It's something that could happen. It's something that will happen. I think we have other people in the driver's seat that I don't think have much incentive to lead us to a world like that Citrini article presented. But point being, keep an eye out. This probably isn't the last time that we're looking at AI disruption fears hitting a certain sector of the market.
My opinion on the Citrinian article is very
Yeah.
simple. It was very well written. To your point, Bepin, read like a novel.
Mm-hmm.
And when people write novels, they do it because they want to get noticed. Okay.
Exactly.
Nobody knew who this team was Saturday of last week. Okay.
People don't know
Nobody
who
had
they are
heard of them
today.
before.
People still,
And
there's a lot of news coming out about the authors. So
yeah, yeah. Well, there's that too. But it was written to get read. Let's put it that way.
mhm. Another driver of the markets that we've been really seeing over the last month or so is jobs numbers got revised downward for 2025. It was one of the largest job revisions on history. 861,000 jobs got removed from last year's job total. What's a little bit more frightening somewhat is if we took out healthcare and social assistance jobs, the job market actually shrunk last year by 500,000 plus jobs. One of the obviously the key culprits of this is likely the no hire, no fire. The only places that are really hiring right now is a product of demographics, healthcare and social assistance. The boomer generation is getting older. They're the largest portion of our population, and they need medical care. So there's always a constant demand, at least currently with the current demographic setup. There's always demand for more healthcare. But the rest of the sectors, we're starting to see a little bit of the AI effect take a hold, where companies are they're not firing people per se, but I mean, if they're not firing people on their earnings announcements, they're talking about we're looking at attrition, a way to get our head count down. And what does attrition mean? We wait for people to quit, or we wait for people to retire. And then we don't rehire that position. We try to find ways to either have another employee do it with the help of AI, or eventually in some roles, they could just go entirely AI. This is something that we obviously keep a close eye on. One positive aspect of this is I do believe that this will increase our odds of rate cuts, or more of them throughout the year. As job risks become more elevated, we'd expect the Fed to respond with rate cuts to help cushion that blow. What's really interesting, and I think Kevin Warsh, the new nominee for Fed chair, highlighted this, which he said, we've never seen something like this. We've never seen a job market kind of be stagnant, or even in some instances falling, but GDP growing. And I think it's really all hinting at the AI and boost to productivity, where you could see less jobs being out there, but you could see more production, more goods, more services being completed. And we really haven't seen anything like that in history. But one of the key points we really want to talk about was that revision, that 861,000 jobs, right? How do these revisions keep occurring? They happened, I believe, last summer, and that led to the last BLS chair being fired. And now we're having a similar issue. And one of the biggest reasons for this, and me and Mike highlighted this during that BLS, that debacle there back in the summer of 25, was that it's survey responses. A lot of companies just aren't responding to surveys. So if you're not having their data, you have to impute it. And then number two is the business creation. They have to make a guesstimate on how many businesses were created and how many jobs would that normally add, to really get a sense of the numbers. And then they revise them once they have more concrete data. What we're seeing, though, that's a little ironic, is that business creation, or at least corporate business applications, is rising. If you'll see that chart there, that bar, that green line, is just going straight up since 2024. But then how come we're not seeing it in jobs? And I think it really all highlights back to that AI trend, where AI is increasing productivity, and a lot of these new businesses are focusing around AI, or at least trying to keep themselves labor light, and they're able to do so with the use of AI, and that's something we expect to continue. This is a new general purpose technology. It'll it'll cause disruption in certain sectors and certain businesses, but I think overall what we're going to be looking at is it's going to be a tool. It's going to be a tool. It's going to enhance a lot more people's jobs than it's flat out replace them. But don't get us wrong. There will be, I think, like we're joking about this earlier, like there will be companies that get completely disrupted from this, or business lines that get completely removed. One that quickly came to mind when we were discussing was Duolingo. You may have seen their app on your phone, or you may have tried to learn a new language on it. Guess what? You can do that with an AI chat box. You can go talk to you could have a ChatGPT or a Claude and tell them I'm trying to learn Spanish. Let's ramp it up from I know no Spanish to I want to be at least proficient to talk. And it'll build a course for you and constantly keep training and talking to you. And you can even hear it. You can have it play its voice and learn if you're saying the words properly. So there's areas that will 100% be removed, but for the most part, we will see advanced productivity and people's jobs actually being enhanced over time, where you're able to do more, produce more, and in theory earn more. So as scary, like Mike said, that novel, that Citrini article, as scary as those type of event or those type of stories feel like, it's always hard to look past those. But we've talked about it in the past. We believe AI will create more good than bad. Talking about the healthcare revolution and all the advancements in medical science that'll come from it, the advancements in robotics and manufacturing, the ability for us to produce more goods in America, whether that requires mass amounts of labor or whether that requires mass amount of robotics. But at the end of it, I believe we will all be better off. I think I saw something from the Citadel. There was a Citadel counter report to that Citrini report that I was reading earlier today. And they talk about John Keynes, one of the fathers of economics, predicted that in the 21st century, people would eventually work 15 hours a day because productivity would be so high, or at least advancements would be so high that they wouldn't need to work. He got the trend right, but he didn't get the overall reality right, which is that as we became more productive, we just consumed more. So that's
Yep.
a world that we could be entering, where it's like, yes, AI might ramp up productivity, but what will that lead to? Likely some things me and Mike and none of you can, any of us can come up with what the future will look like in terms of luxuries we'll be able to do, or things, space travel. Think about that. We're hearing about like Katy Perry gets to go up to see outer space or whatever, be the blue horizon. But that in the future, with the advancements in AI and SpaceX and whatnot, that could become something that more average Americans can do. We just can't even fathom what the future could eventually hold. But I think AI will be more of a tool, more of an advantage for us than a disruptor. And with that, those kind of wrap up the majority of the talking points in terms of narratives driving the market. Thank you for listening. As always, if you have any questions, if you have any concerns, always feel free to reach out to us. Thank you, everybody.